All right, we're going to be doing a fun to fun panel. We unfortunately, Masahiko-san, who runs Incubate Fund, wasn't able to make it today, but we did get a video from him, so we're going to play a little bit of that to get started, and then we'll jump into a conversation here among all these distinguished gentlemen. If we can start Homma-san's video.
Hi, good afternoon. This is Masahiko Homma, founder and general partner of the Incubate Fund. Thanks, Dave, and Nippon Innovation, giving me opportunity to speak about fund of funds for emerging GPs in Japan. Firstly, I would like to talk about the Incubate Fund. I started the Incubate Fund in 2010 together with a co-founder. Now, Incubate Fund becomes the largest seed-stage VC fund in Japan. We have a motto of first round and taking lead position. We think that GP independence is very important factor as VC. Each GP has responsibility of his own decision and takes on full commitment to support portfolio companies from the founding stage to IPO and M&As. We pioneers in building a dedicated deal sourcing team and portfolio supporting team in Japan to realize the full coverage of the best of talents and the founders reach and the startup reach that fit our investment thesis. And also having the dedicated supporting team to portfolio companies in a way of the hiring, PR and marketing and technology perspective. In addition to our investment activities, we have taken many initiatives to build Japan's startups and VC ecosystem, like Incubate Camp, Fund of Funds activity for emerging VCs. This is today's topic, and the deep involvement in the Japan's venture capital associations, and also that we have global franchise funds in Asia and the US with the brand of the Incubate. This is a history of the Incubate Fund. Now we have asset under management of the $1 billion USD in Japan and have been investing over 200 startups in Japan. And through the fund of funds, we have been investing over 500 startups to date. This is a history of how we have been building next generation of the innovation wave from scratch, like B2B SaaS, entertainment, healthcare, fintech, space technology, crypto, Web3, clean tech, taking an example of the Sun Medley, iSpace, and Bitflyer. These are the leading company in the each sector. We have been supporting them almost 10 years when they started from scratch. So we believe that we have been building each of the growing industry and the sector together with a founder from the long time. Here's the team. Besides 5 general partners, we have the 25 front members, 15 middle and back office members, and 10 overseas members. I would like to stress that we have the really good mixture of the generation, from the younger generation to the elder, as well as the diversity of the nationality and the teams. Touching upon the funds activities, we started the fund of funds from the 2010, almost from day one of the Incubate fund. And now that we have largest emerging GPs network in Japan, since 2015 that we split the main fund and this fund of funds activity. And the first fund was set up in the 2018 with a size of the 7 billion JPY, invested 17 emerging GPs funds, and they invested 300 different portfolio companies. Last year, we set up our fund of funds second with a size of the 10 billion JPY to invest 20 funds, and they will invest 350 and 400 portfolio company. This is an ongoing activity. Incubate fund and these emerging GPs are sharing investment methodology and philosophy as a seed stage VC, like how we GP commit and how we do a hands-on supporting to the portfolio company and how we cooperate, how we can do a company formation to create a startup with a founder from day one. Also the sharing supporting infrastructure of the deal sourcing, hiring talents, PR and IR, and technology support we share. And also sharing the relationship and engagement with the LPs, mainly large enterprise and CVC, to look for co-investments and M&A opportunities doing together. With this, we have been establishing the Open Innovation Hub to make a bridge between new startup creations and enterprise and the CVC networks. Seed-stage GPs, we create a community and work as new startups creation lab through the investment activities. And we also create the enterprise and the CVC networks, both that look for the business alliance and the co-investment opportunities, and also the M&A opportunities towards such new startups each and general partner are creating. In summary, I think we believe if we create the number of the founder and the startup, if we increase the number of the founder and startup in Japan, we need to have more venture capital and venture capitalists to match them. Second, we have been supporting emerging GPs to kick off their first fund. There's always a lack of strong venture capitalists and venture capital in Japan that we need to support them. And startup venture capital is always very tough. Sometimes I think the more difficult than to start a startup. Nobody believes in the first timer, especially in the VC industry. Fourth, like founders, first time emerging GPs need support and guidance at initial stage to have themselves adjusted the fit in GP's life. They are most likely very isolated and lonely. So we have been providing hands-on support to them by sharing the methodology and the infrastructure for the deal sourcing and the portfolio supports. And we work together and help them accustomed to be and grow real strong GP for the future. That's what we have been doing regarding the funds on funds activity for the emerging GP and how we help the creating a stronger venture capital ecosystem in Japan for the future. Thank you very much.
Okay, so I would like everyone to repeat with me. FOF, Fund of Funds. Why do we need Fund of Funds? Funds. It's fun. It's fun. Well, that's good. Yeah, you can't spell fun without fun. One check. Sorry. We need fund of funds so that we can have funds, so that we can have startups, so that we can have unicorns. Oh, sorry. See if we can get this working. Can you guys advance if I can advance? I'm not sure. Is there anybody who's good with technology in the house? I might need some help. Lots of words on this slide, but if you look at the bottom, we have FOF. What does FOF stand for again? And we have VC education, because VCs need that. That's the dollars and the light bulbs. And the emerging managers. Emerging managers means rookie VC, first-time fund managers. They invest in lots of startups, hopefully about 100, maybe 500, and about 1 to 3 companies out of 100 startups turn into unicorns. Right, George?
Yeah.
Okay. So that's why fund of funds and VC education are critical for VC ecosystems. Emerging managers, rookie VCs need education and capital. And as Homma-san said, raising a first-time VC fund is actually harder than raising for a startup many times. VC education helps emerging managers learn their craft. Fund of funds invest in emerging managers, sometimes difficult for larger LPs to invest in small VC funds. And then emerging managers invest in early stage startups, and then every 100 startups, we get a unicorn 10 years later. Yes? Eric, do you think what I'm saying makes sense? Check, check. 1, 2, 3.
Hello. Ideally, we get more than 1 to 3 unicorns
Yes.
per 100.
How many do you think out of 100 seed stage startups turn into IPO unicorn size?
8 to 10.
8 to 10? I don't think so, buddy. You're a much better venture capitalist than I am then.
Maybe it's just my track record.
Oh, okay. Wow. Throw down the gauntlet. All right. George, do you remember this slide?
Actually, I think you need to put the slide where you have the little pot of gold at the bottom of the funnel.
Right. I forgot
You
about
need
that
to
one.
dig that one.
So what does this slide mean to you, George?
Well, it's the power law and it's a numbers game. At the end of the day, particularly if you're investing at the early stage, you have no idea which companies are going to be successful.
Absolutely.
At 500 Sharps, we were doing 250 companies per year, average first check of about $100,000. And some of them went on to be not just unicorns, but I don't know.
What do you call the 1000X companies?
Yeah.
we had 2.5 of those.
Yeah. So, but I don't know that I would have ever guessed that those particular companies were going to be the ones that.
But our numbers suggested about 3% turn into IPO or unicorn sized companies. So out of every 100, we were seeing 3 companies. I think we were better than average, but according to Eric, man, we sucked. So the point that I'm making here is in order to get those mature company IPOs, we need to start with hundreds of companies. Later stage VCs are not doing those companies. It's early stage VCs that are doing those companies.
Actually, if I could just say one comment, and really it's a follow on to something Homma-san said. He talked about doing fund to fund. I think here in Japan specifically, what's really missing is growth stage capital. You can invest all day in a bunch of early stage funds, and those are important.
Okay.
But you also have to have somebody who can come in and do the Series B, the C, the D, and write the larger checks. So I think,
George,
as a
what
fund
kind
of
of
fund
checks do you write?
10 to 50 million.
I think that's the Series B and C checks you were just talking about.
Yes. But I think we're kind of by ourselves in Japan right now. I don't know of a lot of funds that do that.
Very good. I'd like to give the rest of the panelists a chance to jump in here. We decided to forego introductions and just jump right in. This slide actually was put together by me, but it was actually from data that Eric had suggested. Eric, do you want to introduce yourself and maybe talk through some of the information on this slide?
Sure, happy to. So Eric Wu, I'm a CEO and founder of a company called Revere. And it was really born out of our experience, myself and a co-founder, where I came from the fund to funds world. So I often joke I'm a recovering LP, which means I don't have to go fundraise anymore, just fundraise for a startup, which, as you mentioned, is easier these days than raising a fund. And then my co-founder spent 13 years in Asia running a family office, trying to fight his way and get access to brand name VCs. And so between his experience and my experience running the emerging manager portfolio at two fund of funds, we saw this power law in effect. We saw the benefits of investing in first-time funds, not only from a returns perspective, but then really following along in their journey as they became, essentially the next generation. And so Revere today is really to take a lot of those allocator tools that we had the benefit from our previous shops, and we're productizing them. And we do that through data, and we do it through software.
So, quick question. We have a list of fund of funds and VC education programs here.
And why is Woven Capital not on there?
Oh, gosh, I'm so sorry. Woven Capital is also a fund of funds?
Yes.
Because you created it, right, George?
Well, yes. But from day one, it's an $800 million growth stage fund backed by Toyota. But from day one, we allocated 10% of the fund up to 80 million just for fund of funds. And to date, we have 9 investments, fund of fund investments.
Awesome.
Yes, they are.
Awesome. Ben, you just jumped in, so why don't you pick up the mic here?
Casnocha, partner at Village Global. We're a $500 million seed firm in San Francisco, and we've put north of $50 million into a pre-seed funds as well. But primarily, we're backing early stage startups across categories. And I think the thing that we're really intrigued by in the fund of fund space and the emerging manager space are actually people who are not necessarily full-time GPs, or they're solo GPs, or they break yet further rules that most LPs apply, because our frame of reference is, who do founders call first when raising capital? It's not always the big bad professional full-time VC. Sometimes it's a fellow founder or a professor or their former boss who might have a $8 million rolling fund and angel list on the side. And so we've anchored both traditional GPs who are full-time, multiple GPs, but we've also backed people who are running very, very small funds, who are not even full-time investing. But it's precisely because they're not full-time that makes them sought after by really talented founders, right? They're still embedded in an operating role at an important tech company, and that makes them very effective at securing allocation in the hottest startups.
Ben, what's the smallest fund that you've ever invested in?
$2 million.
That's amazing. That's awesome.
That was your check or the size of the fund?
That was the size of the fund.
Wow.
Yeah, that's the size of the fund.
Okay. I guess, can we pass the mic to Kobayashi-san? Kobayashi-san, thank you for being here. Wondering if you could introduce yourself briefly, and we can talk a little bit about, your investments at MCP.
Okay, thank you. I'm a little bit stranger today. Actually, I'm coming from more investor side, more financial investor side, and I'm investing private equity or venture capital fund for last 20 years or more. And then part of that, I invested in emerging managers. And then actually, after spending 20 years, I joined MCP Asset Management 3 years ago. And I'm now running, 2 fund of funds. One is private equity. The other one is a venture capital fund of funds for Tokyo government. Actually, Miyasaka-san talked about the Tokyo government, but I'm running, say, program for them a little bit. And then from this program, say, I'm focusing more emerging manager. And yeah, because Tokyo government would like to, say, have a more, say, good GPs in the market. That's more policy reason. But also on top of that, investing emerging manager, that we can have very good financial return in the end. So that's why I say we are running this program now.
So we've been talking about investing in emerging managers. I guess one big question is, how do you know if someone is a good venture capitalist to invest in? And what kind of metrics would you select for deciding? When we look at startups, we kind of look at growth and maybe users and dollars and margins. But for a fund, what are the metrics that you think are interesting? George.
So you actually don't get enough credit, Dave.
I did not pay him to say this. He's no longer on my payroll.
Did you pay me?
I hope so. I sort of.
Back in the day, Dave's philosophy was that we were actually like an old world guild. It was an apprenticeship that the venture partners that would come on, you would give them $1 million allocation and say, go invest it. And the idea
go write 10 checks and try not to screw up.
Yeah. And that was true for everyone on the team. And that's how you learn. You become a good investor by investing and making mistakes. The power law works whether you're a first-time investor or a 10-year veteran. You don't know, but you learn through the process. And so I think, there are people in this room that run funds now that were, at 500 startups, myself included, where I learned how to be a fund manager. I know Matt Romaine, he was a kind of a quasi-advisor, but he's a startup founder. But being close to it and watching it and seeing how it works, there's value in that. So to answer your question, an emerging manager has to understand the investment process and cycle. And I think a follow on to what Ben said, one of our fund of fund investments is called AIX Ventures. They have one full-time operating partner, but the other partners are all professors and operators. And you're exactly right, Ben. If that guy's an expert in AI, the entrepreneurs are going to contact that person, and they aren't full-time GPs. So they then learn investing too by what they're doing. So I think there's a lot of different ways, but at the end of the day, do they have the industry knowledge? Do they have the network? Do they have the ability to actually find the good startups is what I'm interested in.
Eric, how long do you think it takes you to figure out whether somebody is a good venture capitalist?
Well, I think it varies. I don't think there's a formula to it. So let's
Can you tell at first sight? Is it love at first sight when you see an emerging venture capitalist?
It's not
love at first sight.
No, it's
takes years of work on that marriage.
Yeah, it is a marriage, right? You're signed up
longer than most marriages, I think.
I think really the way I would frame this is the power law concept is really a construct around finding outliers. And we have no rules on how we evaluate founders in generating that outlier return, right? Like a college dropout, right? Oh, well, we know they can become very successful. So what's broken, I think, is when you look at fund managers, you're also looking for fund managers who are outliers in their own right. So why do we put all this kind of weird construct around, well, gosh, it's a first-time fund and it's a solo GP and they didn't have formal training at a bigger firm. So it's kind of a weird dichotomy in terms of how you generate power law returns, where we apply that to the startup level, yet we somehow forget all of that and start putting rigid construct around how we look at fund managers. So it's not love at first sight. It's a work in progress. And I think it's one of those things, and if we use the analogy, I mean, you've got to do a lot of dating before you figure out, who you want to get married to.
Yeah, I think one of the reasons, like if you think about some of the highest performing fund ones the last 15 years, like Chris Soccer, lowercase capital one, 250x fund or thereabouts, $15 million fund. Manu Kumar's K9 Ventures was a 69x fund one, I think. Raymond Tonsing's Caffeinated Capital one was like a 45x fund. Chris, Manu, and Raymond were totally non-obvious at the time that they raised those fund
Chris
ones, in
was
my opinion.
Definitely not so obvious, although he had a head start at Google. But
Yeah, I mean, he was kind of like still paying off student loans, I believe,
Right.
and like
Chris was Uber and Twitter.
he did
Right.
Uber and Twitter out of that.
Manu
fund.
was Twilio and SendGrid.
I don't know
think.
if he was in SendGrid. He
Oh, that
co-founded
was later. Yes.
But anyway, I think that the interesting thing for the reason why it's so hard for LPs to allocate to emerging managers is because to assess potential and non-obvious people, you basically have to reference check them madly with actual founders and get the truth. And it's incredibly hard to do that unless you're in the game yourself and know these founders. And so referencing is something that people say they do, but actually don't do, or they do it very lazily, or they talk to people and they can't get the truth. So I think if you're an LP who wants to allocate to emerging managers, you want to allocate to fund managers that have some edge at referencing with founders and getting to the truth. And it's incredibly hard to do that, but that's the only way. I think if you talk to people like the friends of Chris, Manu, and Raymond, for example, you might hear inklings that, oh, they're hanging out in certain circles. They seem to be getting calls from cool people. And I think that's what you're going off of because there's no track record to speak of. Maybe they've done some angel investing, but generally you're assessing potential on the basis of social capital, which comes through reference checking.
Is also why you need a portfolio, right? I mean, that's the idea. It's not all of them are going to be wildly successful.
Not all of them. How about most of them will not be wildly successful? What do you think the median performance of a venture capital fund is, Eric?
On a TVPI basis,
Gross.
gross basis, probably 1.5x.
Not even 2x. Not even 2x. Wow. That's pretty harsh. Kobayashi-san, do you think that you said investing in emerging managers can make money, but how many of them actually make money in your opinion? Let's say if the standard is 2x net, 2.5x net, what do you think is a good target for a fund manager?
In case of venture capital, 3 times.
3 times. 3x gross, 3x net.
Net.
3x net. That is a very small. How many people do you think actually do that?
Well, actually, you say we find a very good venture capital. So I think probability is very high. Probably 30%, 40%.
30% to 4x gross, 3x net.
Yeah.
Well, I think it depends on fund size, right? So
Yeah.
you were giving Andrew a hard time
So
for his.
in general, yeah, that's right. So first time fund, emerging money.
Kobayashi-san, I am raising a new fund. I would like to come see you.
Please. So then your fund one.
Our first fund is my very first fund at Founders Fund. I think I'm in the Chris crew because we had a 60x, 200 million realized on 3 million invested. But I'll never be that good again in my life. But 500 fund one
It shows the
is
power of a small fund. That was a $3 million. These
It's
small
much-
funds can have
it's much
massive
easier to have big outcomes from a small fund. Absolutely. Ben, I want to ask you a question. So how did you get your first fund raised? And what's special about some of your LPs?
Well, I think the thing when you talk to a lot of LPs today, they're overcome by a sensation of sameness. All the funds sound the same. All the strategies sound the same.
Audience, what's the same about everybody on this panel?
Oh, I'm sorry.
You were going to say white men. You were kind of right. It's white and Asian men, but it's probably dominant race men, at least in their geographies. What's wrong about this panel? Skylar, come on up here for a second. Skylar, I think you need to moderate the rest of this panel.
Awesome. Absolutely. Well, thanks for having me. Hi, everyone. A little bit about me. I'm Skylar. I'm currently a venture capitalist Incubate fund, and I'm diversifying this panel a little bit. Yay. So I think Amazing. So I think we were asking Ben about yeah.
LPs hearing not just GPs that look very similar, which is a great point, Dave, but also strategies that sound very, very similar. So every GP is saying, oh, they're founder friendly, or they have some value add, or what have you.
Could you stand up? George, could you stand up? Okay, which guy you want to give venture capital money to?
That's why he had me fundraise for it.
Skylar, stand up. How tall are you?
Usually tall.
Taller than me. You should give her the money.
Yes. Give money to tall African American women like myself. Yay. Amazing. Okay, let's continue.
So yeah, punchline, I think differentiated strategies matter. So we had a very different sort of strategy when raising our first fund. I think when I started my first company years ago, I remember reading a book that said it's better to be a lot different than a little bit better. And it's best to be a lot different and a lot better. But to get in the door, to start a conversation with LPs, I think it's helpful to be different and exciting and have a novel approach. And then if you can get lucky and also be good and the strategy works, then you can compound upon that success. But for us, we were pretty keen on a different sourcing strategy and selection strategy, and that allowed us to raise our first fund.
And I'd like to just make a quick comment. So 500 startups, I'm sure you're all familiar with, but there were several regional funds, and we set up 500 luchadores in Mexico. And how old were they at the time we were doing that? 25, 6? They were under 30. And then how old was Kylie when we set up 500 Durians? Also definitely under 30. And the reason I remember this is because in both cases, we were raising money from the Mexican government and in the case of 500 Durians from the Malaysian government. And they asked me to come in as the old white guy with white hair and wear a coat and be the adult. And so there is also an age element too. And so I would go in there and I would represent 500 startups and try to give them confidence that we had a platform. And that's really what it kind of comes down to, is that who am I giving my money to? Because it's a 10-year to 15-year marriage, and you want to know that they're going to be a good fiduciary and that they're going to manage it well.
Great. So definitely the theme has been so far not knowing exactly what people will make a great fund manager, but also looking for things that will make you stand out or interesting. And as someone who, would love to have her own fund one day, I guess I first would love to better understand when you're building these relationships with potential fund managers, and there may be differences. How do you go about kind of navigating those relationships if, maybe they don't look the same, or maybe even come from the same geography or cultural background as you? So anyone can take that question.
Yeah. So we've actually created at Revere the world's first fund manager rating system. And it was a forcing function, because if you think about a lot of what we've talked about, you've got personalities, you've got preferences, and, you can have a coffee meeting and say, hey, I would give someone, my money. But when you apply the data element, it was a forcing function for us to say, we need to actually score people, right? And by coming up with a scoring system, you are forced to say, hey, this person's not ready, right? Versus this one stands out for these reasons. And of course, we got 20 different categories. So there's no singular kind of A+ score. It's kind of a heat map of different scores. So I think it starts with reframing the question of, like, we actually do have to put standardization around how we evaluate their potential as fund managers. And from that, then you can really introduce this concept of, this is what you need to work on, because relative to everyone else, your firm management sucks, or your sourcing channels need to be improved.
Great. If I could maybe double click on that really quickly, what are some of the factors that go into the score, maybe even general categories?
Well, we have several categories around value add, right? And of course, everyone here on this panel has been pitched, we add value, right? And they might flash up, 1 or 2 case study slides. I mean, that's kind of like barely enough, right? Because everyone does it. So we've actually seen some fund managers where they have tracking spreadsheets, they have CRM systems that actually show the connectivity they make for their portfolio companies and how it led potentially to revenue, right? Or pilots. So that's a high scoring fund to be able to show the systematization of how they can track a category as specific as revenue generation. So that's just, one example.
One thing, and I kind of learned this the hard way. Another area you look at is track record, their investment track record. And they may have worked, like in your case, they work at another fund, but depending on their level in the fund, and this is actually a kind of a dirty little secret, a lot of the big name funds, they own their deal flow. You actually sign an agreement saying that you can, even if you sourced a deal, when you leave, you can't say I sourced it. It's the fund's basically, property. Now people will still do it and they'll do it privately. But it then becomes a little murky. Like, did you really source that deal? And okay, you sourced it, but did you negotiate it? Did you close it? Did you sit on the board? And so we look at all of those things through the life cycle. And that's the real challenge in evaluating a manager, because there's a life cycle to each investment. And that life cycle is easily 5, particularly for early stage companies, maybe it's a couple of years if they fail quickly. But if they're around and they're actually going to get to an exit, it's a 10 to 15 year process. And most emerging managers haven't been investing long enough to actually have been through the full life cycle many times.
Great. So we're sitting in Tokyo right now. I'm not sure how many, or if the panelists today have invested in Japan-based fund managers, but considering the level of ecosystem now, are there any factors that you would look for in fund managers looking to invest in Japan?
Yeah, because I invest in Tokyo, so I focus on Japanese managers. Unfortunately, Japanese market is very small. So basically say we don't have to have tracking system so that we know people very well. And many cases, or not many cases, but sometimes I encourage people to spin out from large venture capital to start own shop. So basically we understand about person, what they are doing, what kind of track record he or she has. So then after that, we encourage them to go independent. That's a very typical case.
I have a question for you. In Japan, I know it's a common phenomenon where former operators, become angel investors and then they start their own venture fund. Is that something that's common practice in Japan or not so much?
Yeah, that's common practice in the US.
Yes, right. The question is that an archetype of new fund managers in Japan?
I think it's getting more common. Yeah.
Yeah, because I think one of the huge shifts in U.S. venture capital the last 20 years has been the decline of finance backgrounds and GPs and the rise of operator entrepreneur backgrounds. But in a lot of global markets, I've noticed it actually still primarily finance folks who become GPs and not so much the ex-entrepreneurs. Even within the US, the East Coast versus West Coast is a big difference in terms of the background of GPs.
Great. So on the topic of background of GPs, looking at either the US or any geography you'd like to focus on, as far as the background, do you see that there will continue to be shift to, at least in the US, more entrepreneur, operator-backed fund managers, or will the landscape of these profiles continue to change?
Well, I think if you're running a small fund and you're a solo GP, I think you can have a kind of pure operator background and be successful as an early stage venture capitalist, because so much of it is just sourcing, and you're not trying to manage a large finance organization. So sort of my prediction is that we'll see over the next 10 years a continued proliferation of these small venture funds run by 1 or 2 GPs, in large part empowered by platforms like AngelList and Carta, which make it so much easier to run the back office. I'm sure when y'all were running 500, the back office complexity must have been insane.
It was an Excel spreadsheet.
Yeah, which is just mind blowing. And so it's so much easier today.
I think we migrated to Google. Sorry.
Yeah. So anyway, I think there'll be a bunch of these small funds that are run by operators. I think of the large platforms, like if you think about, because we're talking about Andreessen Horowitz earlier, and the sorts of people that run Andreessen's operations and management team are going to be more seasoned, ex-bankers, finance folks, and so forth. But there will be a huge number of operators that run subscale venture funds hosted on these platforms like Carta that are probably under 100 million in size. And I think those are the funds that will generate 5 to 10, 20x returns potentially. And LPs should probably allocate to those managers if they can identify the best ones, which is hard to do. And so if you can identify fund of funds, perhaps that can in turn identify those on the ground operators, I think that could be a money-making strategy.
I was just going to add, like for us at Woven Capital, we had 2 criteria for all of our fund investments. The first one was that they had to be sector area experts. We didn't invest in any generalist funds intentionally because we're a strategic corporate VC and we want to make sure we're covering specific industries. So for example, we invested in Ballistic Ventures. They're a cybersecurity fund. They only do cybersecurity. And the people that run that fund, they came from the industry. They're operators or they're investors who've only invested in that space. So I think it also depends on the fund's strategy, the fund that you're investing in, whether they need operating experience. If you're a generalist, you're not going to know every industry. Are you teachable and learnable? And like, can you actually get the entrepreneur to give you the truth when you're quizzing them? That's maybe a different skill set versus having a true expert who knows the industry, either because they've worked in it, because they've invested in it, and they have the network in it to actually get the truth. So they can either get it externally or from their own experience, or they have the ability to interrogate an entrepreneur and get it from them.
Oh, would you like to?
Yeah, I the only thing I would add, I think it's, and we've mentioned this before, today in early stage venture, and I guess US anywhere, you have to kind of really understand what do the founders want out of that first check writer, right? So if you work your way backward from that question, that's where, let's say they are in a deep tech space, then of course they're going to want, a technical kind of co-pilot to help them figure that out. If you're a consumer startup, you may want the celebrity or the influencer, right, to help you with that go-to-market. So I like the concept of thinking about, in this generation, what do founders demand from their first check writers? And then you can kind of map that decision tree back into what are some of the interesting backgrounds and networks and strategies that would make these smaller funds successful.
And Eric, do you think I remember talking to someone at First Round Capital years ago, which First Round is a large seed fund in the US that's invested an enormous amount of money in platform services kind of before it became popular. And I asked someone there, do you have all these services because you actually are helping the companies post-investment, or because it helps you win the investments on the front end because it has the perception of being helpful, but in practice, it's actually not helpful? Like when you're researching managers and thus talking to founders about their experiences, are you trying to look for examples of where the VC has actually changed the trajectory of the startup? Or do you think this whole discussion about value add is mainly optics, and we're actually going to move to a different world where groups like Founders Fund are proudly saying, we don't add value, but we also don't subtract value, and that makes us better than 80% of VCs?
Yeah, it now being in the founder position, I think hearing about the platform services is an attractive feature in terms of winning the deal, right? So you always go in there and basically it's a beauty pageant, right? And you say, oh, well, you got all these services, and they say they're going to add all this value. So I think it does help to win deals. But when we actually measure and we go through the diligence process, we are asking them what happens post-investment, who follows through, and how are they following through, right? And I would say even those largest platform services, the percentage of times that they actually can make an impact is quite isolated, right? And so that's why you need to ask those questions, and you need to actually start measuring that.
Gentlemen, we've had a great conversation, and I think our moderator's done a fantastic job. The co-moderator, no, not the first one, the second one. Could I ask you one last question, which is, you've all been investing for at least, let's say, a decade, in some cases more. What advice would you give yourself, the younger you, getting started in venture capital? You talking to yourself, the emerging manager.
Don't leave 500 startups in 2014.
Oh, yes.
I think there's a lot of theology around how to make money in venture and how venture strategy should work. It's stunning the degree to which people have almost like religious beliefs in portfolio construction. For example, there are a lot of what I've learned and what the advice I give myself is there are a lot of ways to do different strategies. There's no one right way. And as you study examples of success, you'll find really compelling examples of very different strategies. Super broad portfolios, super concentrated portfolios, global or domestic only, sector focused, generalist. I mean, there are a lot of ways to do it. Huge platform teams, literally no platform teams. I know a solo GP in the Bay Area who manages $700 million. He doesn't even have an EA. It's just him. I mean, it's stunning. So there are a lot of ways to do it. Don't get trapped in any one loud person on Twitter's theology about how to run a venture firm.
Loud people on Twitter? Who you're talking about?
So my advice is I think about a little bit more midterm strategy. And of course, first time fund, raising fund is very tough, but also more tough to raise second fund. And so they say venture capital should think about how to raise second fund since beginning.
Yeah. So my advice is take risk, right? I think a lot of emerging managers kind of scare themselves into, I have to say it a certain way because an LP told me I have to, have a certain ownership percentage. But at the end of the day, if you take the risk, you kind of the world of karma kind of finds its way to you, whether it's the founder, whether it's the LP who sees something in you before you see it, but it all indexes around being able to embrace and take the risk.
Thank you guys for having a great conversation. Thank you to Skylar for jumping on stage and freestyling.
Thank you.
All right.